Welcome back, Dana.
Thanks, Dale. Nice to be back.
Okay, so do you remember how to use Zoom to share your screen?
Well, how about that green button that says share screen?
That's the one.
I'm telling you,
Okay.
you're like Sherlock Holmes.
All right. Should I just click that and just leave it on that? Yeah.
Click that and then choose the screen you want.
Click that and then you have to choose which screen or window you want to share. And then you're good to go.
I got you. Excellent.
So I was really looking forward to you coming back. I was just telling Steve that last time you were there, and it was before the highs that we had in February. I'm not exactly sure, but you still brought up the secular case, secular bear case, and that's what it did. Kind of just washed out under those lows for to go the bottom of the megaphone.
Yeah,
and that was a great call. That no one's saying that we're in a secular bear. So
right.
even though they're long and participating in the market, I'm not saying you're a permanent bear. I know your positioning is with the trend.
Yeah.
So I guess the question is now, Dana, that we had that break and here we are at new highs. Is this just like a continuation of a broadening formation? Why don't you tell us what you're seeing?
Yeah, sure. Well, it depends what index you're talking about. So, and it depends not just on a price series like the S&P 500, but we're really talking about the economy, the market, the broad stock market as a whole. So our thesis was still that in 2000 we topped out, and the way that secular cycles work is you have big buildup over, secular bull market over a couple decades, and you build up these excesses in the market and the economy, and they have to be worked out and corrected before a sustainable bull market can commence.
Fed won't let that happen, Dana, will they?
Pardon? Well, that was going to be my point. In 2009. Yeah. It works just like physics. You go to an extreme to one side, then you have to go to the extreme the other side. It's like Isaac's laws of physics. Right. And we basically in 2009, it was bad, but we really got down to the mean in a lot of economic and market metrics, valuation, the percentage of household assets and stocks, even price trend itself. So we never corrected to, the bearish to the downside extreme like we needed to, thanks in part, I think, to the Fed and central bank intervention, like you mentioned. So I think that had a lot to do with it. So now we have a lot of those excesses that are still in the system from 2000, in addition to everything that's been put in since then. So I don't like to opine too much on central bank stuff, but just looking at why the cycle hasn't played out like it always has, I think that has a lot to do with it. Now, if you look at, for example, we have the S&P 500 back testing all-time highs. But if you look at, for example, here's the value line geometric composite on my screen. You see the top in actually 1998. We've gone pretty much sideways since then after the long bull market preceding it. So the median, the value line tracks the median stock performance in the market. So basically we've gone nowhere. Now most people are in something like the large cap, the S&P, some of the NASDAQ type, whatever's popular in the day. So most people have done a little bit better than this, sure. But if you look at the broad market of stocks, we really, it's still conceivable to make that secular bear market thesis. So that doesn't mean that, as you alluded to, that doesn't mean that we're going to invest our clients' money based on that. We're more intermediate term duration. So for 2 to 6 months, our normal signal lasts. So we're gonna have to be on the right side of the market during that intermediate term duration, or else all our clients are going to fire us.
Did the magnitude of this bounce after that crash surprise you?
It did. I'll tell you, not much surprises me in the market anymore, but the magnitude, the way we bounce back, I mean, face it, we had the biggest, swiftest crash in the history of the U.S. markets.
Right.
To expect the swiftest rebound in the history of the U.S. markets was, if you're going to tell me that you expected that, I'm not sure I would believe you. So we were surprised at that. At the same time,
I was trying to sell failing rallies at different fib levels.
Absolutely.
So
the big one, if you look at the value line here, the big level was in early June. So this is
right.
Still, if you look at the broad market, so in early June, we pretty much failed right at that 61 retracement from the 2018 top. Also, you had a couple the green lines, the 200 moving day. So you had a bunch of technical reasons why we should fail there, even though the S&P and some of the large cap averages had moved well above those corresponding levels. So we did top out this move in early June, kept the bear market, not the secular one, but the near-term bear market thesis on the table, that this move since March was merely a bear market rally. Now, recently, we've seen some of these lagging areas of the market, small caps, financials, energy, some of the European and international markets move back above some key resistance levels, opening up further upside. So that does open up a little bit further upside, and we have some of the leaders going to all-time highs. So it makes you reconsider the fact that, okay, we had a bear market in March. This is just a bear market rally. So maybe it's something more than that. And you have to consider that it's going to extend even a little bit farther.
Okay, here's a key question for you,
sir.
Dana.
Yeah.
I'm transferring my $1 million trading account to your RIA. All cash, all right? It's all cash.
Yes, sir.
What do we do here?
Our philosophy is we're going to be investing with a trend. The trend right now is up. Our risk model, which is comprised of a lot of breadth measures, is strong enough. It's stagnant a little bit now, but it is still in a buy position. So we are still.
So you put some of that money to work. All of it.
We're still bullish. The problem is right now is it's not. Like I heard, I was listening to your prior commentator, and he was mentioning, if you're long now, we would stay long. If you got a lot of cash on hand, we wouldn't necessarily be deploying all that cash right here. So that's basically in the position we're in. So we're long. Okay. We're long a lot of the longer term relative strength areas, technology, healthcare, stuff like that, stuff that's been working for a long time.
Were you there for the miners?
Gold miners, exactly. The gold miners as well. So those relative strength leaders, that's our philosophy. We want to be in the stronger areas of the market over the longer term. So those areas, we'd be looking to redeploy that money and buy the dips. The laggards that have come on of late, small caps, financials, energy, those are more of a that's more of a flash in the pan type of move to us as of now, until they show something on a longer term basis. We're going to avoid those areas. We're going to sell those rallies. We're going to even try to short some of those areas into resistance. So we've seen
Dana, isn't that also a sign of a rally being long in the tooth when they rotate into the trash non-performing stocks?
Sure, that can be. We have a number of other red flags that we've noticed as well. Some breadth has held up okay. We've seen some one-off days where we've seen big rallies on terrible breadth, and that has often happened in near peaks in the market, although not always. So that's more of like I said, one-off little red flags. We also see, like your prior commentator mentioned, we see volatility holding up relative to the moves we've seen in prices. So
we never filled that gap at 18.
Yeah, that's a concern. But I would say it's not according to our models, it's not enough of a concern to get too defensive yet here. So that's we're kind of. I wish I could say we're at a bottom or we're at a top, and now's the time to make a lot of moves. But basically, we're in kind of a holding pattern. We're still long. We're just not going to be that as aggressive in putting money to work right now. Here's the VIX. Right. Yeah, we didn't fill that gap. Actually held the 88 retracement and some other support areas around the 1920 level. So perhaps even more interesting, the volatility index and the Nasdaq 100, which is held up well above the prior lows, actually well above even the June and July.
They're making higher lows.
Yeah, so that's one of those red flags. It doesn't go into our models necessarily. It's not an actionable indicator for us, but
up until the last couple of days, growth has been, they rotated out of it for a while, and Nasdaq hasn't made a new high for, almost a week or two.
Yeah,
it seems is like a lifetime when S&Ps do it every other day. I wanted to bring up something that I think just began this week. 10 years, the 10-year yield chart was like a patient in a coma, their EKG for a long time. And to me, it looks like we're coming out of here. I'm going to have a 2-week reversal signal in the 10-year. And I can make a case for 120 in the 10-year. I know a lot of, and the mantra that is so universal, and we were even talking about notes and stuff here, is first of all, you don't want to fight the Fed, but everyone is saying lower for longer.
Right.
Paul's saying, I'm not even thinking about raising rates. Market, he doesn't have to do it. What's your view on yields here? And would a move to 120 in the 10-year upset which apple carts?
Well, first of all, taking a step back, if you leave the long term cycle of interest rates, we are due to bottom. The 60-year cycle, roughly, we're due to bottom out in rates about 10 years ago. So you talk about another cycle that has been kind of upset by maybe some of the central bank action that's taking place here and around the world. So back in really and when you talk about lower for longer, I think it's a key psychological factor or condition for putting in the long-term bottom in rates, because all you've heard from around in the 2000s, from 2000 to up towards the financial crisis, all you heard about was, okay, rates have to go up, there's nowhere to go but up. And once we got to that lower for longer, okay, we're going to be in this low rate environment forever, negative rate environment. Then you put in the psychological condition where we can put in a long-term low and then start rising, which we think we will. So we think rates go up for, decades to come. When that starts, I don't know. We thought it would have started in 2016 at that low. Didn't happen, obviously. We rose for a couple of years, but now we're back making historic lows. But if you zoom out,
we didn't make historic lows. We got down to 50, and the spike on COVID, I think, was 34. And now it looks like we're starting to head up. And I'm not talking about this wave going to 4% on the 10-year, but why not back to 120, which was a pretty important support level before the acceleration? And do you think the market's prepared for that? Would be like up 125% from the recent reading of 50. Would it matter?
It absolutely would matter. I don't think anyone's prepared for that. What my historic move was that move in March, I'm saying. And if you're looking for this is kind of anecdotal, but if you're looking for an ending type of a move, this blow off that we had in March, that would certainly be significant enough to end a long-term 30, 40 year run in interest rates. But you talk about the 120 level, I'm looking at the same thing. Held support at 50 basis points, testing that 50-day now, trying to get above. If we do decisively break above that 50-day here, around 65 basis points, I'm looking up towards about 108 or so on the 10-year and up. About, if we break that, maybe I'm looking at 150. So I could see that happening quickly. Obviously, I don't know anyone.
What would be behind it? Because everyone will go, why did the 10-year go from half to over 1? The Fed's not doing it. Could it still be with everything the Fed has done? Before we had the crash, we had those issues in the repo market last fall. Could it still be that there's liquidity issues in certain money markets? I can't think of any other reason for rates to make this move. I'm wondering how. I'm not a reporter, but I'm trying to guess how they're going to explain it.
I thank God I'm not a reporter either. So you got to come up with reasons.
Well, they come to us. We'll have an explanation then.
Right. Well, the boring answer is I don't care what the reason is. Because we're going to follow the market data. And
that's wisdom.
We're going to follow prices. So I don't know what the reason would be. This is still a free market, right? So this is not Fed funds. We don't get set by the Fed funds. So this market's going to move based on market forces. And for whatever reason, if we go up there, that's where the market has to go. So it's not, a couple central bankers setting rates on the 10-year. Obviously, they have a huge influence over that, but they can't necessarily control that. So the market forces, there are a couple of things, we've talked about it before, a couple of things that are bigger and more powerful and I guess stronger than any central banker, any policy maker can. They don't have the ability to permanently control things like the economy, the stock market, the 10-year, the bond market forever. They can distort it temporarily. They can't permanently control markets like that. They're too many players, too much money, too strong a force for one individual or one central bank to necessarily distort forever. So that's my
Someone
view.
Just said printing $7 trillion in a matter of months gives you a lot of control.
Sure, it does. And we've seen
the result of it.
I mentioned the interest rates were due to bottom. The window was about 10 years ago. So yes, you can distort it for a while, not permanently, not based on hundreds and hundreds of years of history.
Okay. So if we get this move that you think is viable, could happen, what's going to suffer? Utilities, REITs, interest sensitive sectors?
Sure. Dividend stocks, obviously, things that have those types of areas that have been lagging for some time. So that would, obviously, those areas we'd be avoiding. So we're already avoiding those areas, but the utilities had been. It was interesting. The utilities were one of those leaders for a long time, like the growth areas of the market that were leading. You had weird things like utilities doing well, and all of a sudden, since about April or early May, they have not been doing well. So why is that? I don't know. They haven't. So maybe that's a harbinger of some kind of an interest rate move here.
So maybe the thing to really avoid would be weak credits. If they're weak credits now I'm talking about junk, which used to be, AAA, that rise in rates of a point might cause some duress in the bond markets. What do you think?
Yeah, that's true. And we've seen, if you've been looking at junk bonds of late, we've seen we've seen them struggling. Some of the at least the junk bond ETFs, they've not kept up with the recent bounce in some of the junkier equity issues and equity spaces that we've seen of late. We've not seen high yield keep up with that. So that, to your point, that might be a sign of exactly that in the works here.
How do you label what we're going to be facing with, all of this artificial actions that have taken place? I think, really to keep everything going to year end, which includes the election, right? Next year, and a lot of it depends upon, do we get a second wave? It's called, do people stay home, reinforce their lack of consumer spending, especially the people with money over 55, 60 that are higher risk. Do you think that what we're facing is a credit crisis coming or a solvency crisis? And isn't there a difference between the two?
Yeah, I think I think it's going to be just a straight up demand issue. It's going to be. I have to think it's going to be extremely deflationary. What's going on in terms of shutting down the economies, the lack of obviously a solvency issue for many small businesses, which are just going to vaporize. So whatever it is, again, we don't care what's happening. All our clients care about is what's happening in the markets itself. So we're gonna. I've told a lot of people, we continue to say that we ignore all the fundamental data, the economic data when we're managing markets. If to the extent that the economic data is relevant and pertinent to the moves in the markets, it's going to show up in the data from the market. So we look at only quantitative data from the markets itself. And if it's relevant, it's going to feed into it. So the markets are you look at the stock market, it's the best discounting mechanism in the history of the world, right?
Yeah, people are voting with their wallet.
Exactly. And humans can't process that faster than like billions of inputs faster than the stock market. So take your cues from the markets. Ignore the noise unless you're, the greatest even the greatest forecasters of the market, of the economy and fundamentals. You can get that right and still get the market reactions wrong. So we'll stick with the market.
A call
data.
and a trade are two different things. So how about the dollar, Dana? Dollar has given up, euro from 108 to 118. You have a view on the dollar here? Is this a severe breakdown on your technical work?
It's a breakdown in the near term on the dollar. So long term, up in the air. We don't have really a long term view. We're not taking a stance on that in the short term. I would say the benefit of the doubt is to the downside in the dollar index with next level around 91. So we're trading around 93, right? Anything up towards 96, we'd be selling it. 96 and a half would be selling it, maybe even take a shot up there on the short side. So right now, benefit of the doubt is to the downside in the dollar.
Okay. And I know you have friends and relatives that aren't your clients, right?
Mm-hmm.
Okay. So I get asked this all the time. Dale, with what's happening in the economy and what could happen in the economy, I just don't understand. How could the market be making new highs? What do you tell them?
Well, again,
you get asked that question, don't you?
Yeah, like I just said, that's why we ignore the economic. And who in the right mind would be expecting all-time highs right now, coming off of GDP dropping by a third, and 10% of the labor force got laid off in 1 month. I mean, who in their right mind would be would have any money at all in the market right now?
Right.
So
how do you explain it to people?
I say don't even try to reconcile the two. Divorce yourself from the fact that the market has to go with the economy, or I say, you know, find a good objective risk conscious money manager and let them manage the money for you, because they'll know how to they'll know the inputs to look for, they'll know what to ignore, and they don't get hung up on, you know, trying to reconcile the two. So
how are you doing this year, Dana? A little bit more than halfway through the year, ended quarters. How did you weather that decline, etc.?
We weathered it pretty well. So I mean, that's our calling card. We're gonna aggressively manage risk when we detect it. So we lost a little bit in the first quarter, you know, the small single digits. So we aggressively went defensive there in the early March, right?
Yeah.
Right in the beginning, towards the beginning of that swoon. So we had some red flags going into that top. We were about our risk model was a week late in getting a sell signal. So almost a perfect sell signal, but that last week of February was really bad, if you remember. Yeah. So we got clipped a little bit, small single digit losses. Since then we've made basically triple back what we lost there. So nice. I think our clients are happy. We are always going to lag a little bit in the explosive moves off the bottom like we saw in March. So certainly we've lagged the market. We're not up 50% from the March lows, but you know, you keep your losses small, you keep your drawdown small. You don't have to recover as quickly. You don't have to make as much back on the rebound just to get back to even and then start growing your money again. So that's why we always preach the most important thing is keeping those losses, keeping those drawdowns small, relatively small.
So Dana, if someone wanted you to manage a part of their portfolio, how would they reach you and get a hold of you and discuss it with you?
Well, you can reach us. I've got several. We got a website, but we got several blogs, several services that we can that we do provide. So
you want to show them?
Sure. Let me figure out
new share. Yeah.
What's that? New
you
share.
You might have to do a new share.
Perfect. All right. Yeah. The best way is. Let me still figure this out, buddy. How do I get on? Okay, here we go. Best way to get a hold of us, you can check out our website is Lionshare. The Lionshare, it's at lionsharepro.com. You can find contact information there. This is one service. We have our management service. This Lionshare is more or less a do-it-yourself service where we provide basically on a daily basis what we're looking at, what we're looking to buy and sell, and subscribers pull the trigger themselves. But it's kind of a open lens into how we're managing money and the kind of things we're looking at. But if you want to as far as our management service, it's JLFMI.com, and you can email me at info@JLFMI.com or dlyons@JLFMI.com, and you can find us that way. And you know, it's if you're looking for a way to manage risk and add a significant risk overlay to your investment portfolio, that's really our calling card. So like I said, you know, we're not going to try to squeeze every single penny out of every up move in the market. We're going to manage risk, keep our drawdowns low, and
the difference between pros and amateurs are pros know how to lose, so they have money left to be right with.
Exactly. So, that's the most important factor, knowing when to pull the trigger on the sell side. Absolutely.
Best idea going into the election, Dana?
Into the election? Wow. Right now, like I said, it's boring, but we're following the same stuff that has been working. So we're not going for the flash in the pan recent move in the small caps and financials and whatnot. We'll stick to the longer term trends, technology and healthcare, and go with that. I would say one long shot would be Taiwan. We like Taiwan in the long term. Why? Because of the chart. We have. If I can do a quick screen share, if I have time for that.
Yeah, go ahead.
Okay. So we've had, you talk about a long-term bear market. We had Taiwan, which topped out in 1990. So whatever's going on, I know
when the Japanese did.
Yeah, I don't know what's going on in a lot of things going on politically in China and Taiwan, Hong Kong. But you had that top in 1990 in Taiwan, the Taiwan Major Index. Then you had a series of highs for the next 25 years. Broke out of there a couple of years ago. We've been consolidating. Just broke to a new high, all-time high here at the right of the chart above the 1990 high. I mean, you talk about, they say the longer the base, the bigger the space to the upside. This is massive upside potential if this breakout is for real. So if you want a wild card in your portfolio, you're looking at emerging markets, this would be the one that we would pick.
I'll call it your speculative shot. Okay?
Sure. Well, we're along this already. EWT would be the ticker symbol, which tracks it pretty well. It's actually at new all-time highs as well. So EWT, small speculative position.
Well, I hope you and your family stay in touch. Any view on COVID?
Now we're just praying that everyone stays well and that this thing runs its course quicker, quicker, sooner than later. So I don't have a view on it, but praying for everyone out there to stay safe and socially distance, and hopefully this thing runs its course soon.
Thank you so much for coming here and sharing your views with us today, Dana. I always enjoy it, and I know I could ask you anything, and you'll come right back to price.
Yeah, I appreciate it, Dale. Always enjoyable talking to you, and price is truth, and stick with that. Ignore the noise, right?
All right, my trading warrior brother, everyone, Dana Lyons, you know where to find him. I would trust him with if I had a lot of money, I'd give you a piece, Dana.
Thanks,
anyway, so that's going to be a wrap. We'll see everyone for TGIF tomorrow. And again, my trading warrior brother, I appreciate your views. And, I could kind of tell that you're getting a little strongly neutral here after this advance. Let me know when you guys get a sell signal, and let's get together maybe after the election and see what's happening price-wise then.
Sounds great. Always a pleasure, Dale. Thank you.
All right, Dana. All right, everyone. Remember, don't just count your pips, count your blessings. We'll see everyone tomorrow. You're welcome. Adios.